Should you invest outside of the United States or keep everything in American companies? In this episode of LawyerFi, we'll explore total international stock index funds, what they are, the arguments for and against them, and why this decision could shape the way you build your portfolio.
This is the LawyerFi podcast, equipping lawyers and other high-income professionals to reach financial independence. Adam B. Cordover is a Florida-based collaborative family law attorney. He is not a financial advisor, accountant, or tax attorney. This podcast does not provide legal, financial, or tax advice, and is for information and entertainment purposes only.
Welcome to the LawyerFi podcast. I'm your host, Adam B. Cordover, and I hope to equip lawyers and other high-earning professionals with the tools to reach financial independence. Today, we're asking a key question. Should you look beyond the United States when investing? If the answer is yes, then you may want to look at total international stock index funds, of which I'll give a brief overview shortly. In this episode, we'll explore the debate around whether you need them at all. Legendary investors like Jack Bogle and J.L. Collins argue that sticking with the U.S. alone is perfectly reasonable and, in fact, preferable, while others such as Ferri, Jim Dahle, and Paul Merriman believe global diversification makes more sense. Along the way, we'll consider different allocation strategies, use Japan's market history as a cautionary tale, and even weigh the pros and cons of choosing a single total world fund instead of managing U.S. and international separately. And later in this episode, I'll highlight the main international fund options from Vanguard, Fidelity, and Charles Schwab. So let's start by taking a closer look at what these international funds actually are and how they work. Total international stock index funds aim to capture thousands of companies around the globe, businesses in Canada, Europe, Japan, and Australia, as well as emerging markets like China, India, and Brazil. These funds are the counterpart to U.S. total stock market index funds, which invest in nearly every publicly traded company here in America. If you want a refresher on those, we took a deep dive into the U.S. total stock market index funds back in episode 25-003. A total international fund applies the same philosophy but focuses on every market except the United States. Further, they tend to have ultra-low costs with expense ratios of 0.06 or lower. That's essentially a $6 fee paid annually for every $10,000 invested, which comes directly out of your investments. Again, we will give examples of specific funds later on. And just like with U.S. total stock market index funds, they are market cap weighted so that when a company grows, its share of the index increases. And when a company falls on hard times, its proportion in the index decreases. Now, big names in the financial independence movement have differing opinions on whether you need this international exposure at all. On one side, you have the late Jack Bogle, the founder of Vanguard, who pointed out U.S. companies get half of their revenues and half of their earnings from outside the U.S. You already have an international portfolio, he said about owning U.S. companies, which have global reach and international customers. He then asks, why do you want a larger one? In other words, Bogle believed that owning U.S. stocks already gave you significant global exposure, so adding a separate international fund just isn't necessary. J.L. Collins, author of The Simple Path to Wealth, takes a similar stance. He explained, I have never felt the need to own an international stock fund, and still don't. That said, I have no strong objection to doing so. If you feel the need, you have my blessing. This captures his preference for keeping things simple, while acknowledging that international exposure isn't a bad choice if it helps you feel more comfortable. On the other side, many respected voices argue that you don't want to miss out on international exposure. Ferri, a well-known investment advisor, author, and former president of the John C. Bogle Center for Financial Literacy, notes, the data shows that allocating 20 to 40% in foreign stocks has provided a diversification benefit in long-term portfolios. And what he means is that even if international markets don't always outperform, they tend to move differently than the US market, which can smooth out your returns over the long run. Dr. Jim Dahle of the White Coat Investor adds another layer to this reasoning. He often reminds investors, quote, diversification protects you from what you don't know and what you can't know. Being diversified means always being unhappy with something in your portfolio. In other words, no matter what you choose, when you are diversified, it is likely that part of your portfolio will always lag behind. But that's the price you pay for spreading your bets and reducing risk. Dahle explains he expands on this point by saying, the primary reason to invest internationally is diversification. While the stock markets of the world have become more correlated over time, they are not perfectly correlated. They perform differently and provide important diversification benefits. And Paul Merriman of the Merriman Financial Education Foundation made a similar observation. As he puts it, adding international stocks doesn't necessarily boost returns, but it can help smooth out the ride. His point is that international exposure isn't about juicing performance. In fact, there's a decent chance that adding international funds will decrease the total value of your investments after decades. However, Merriman's point is that this possibility is less important than managing risk by making sure you're not overly dependent on a single country, even if that country is the United States. So, what do you think? Is the simplicity of a US-only portfolio enough for you, or would you feel more comfortable knowing you're invested across the globe? When people debate whether or not to invest internationally, one story oftentimes comes up: Japan. In the late 1980s, Japan was nearly half of the world's stock market. At the time, it seemed unstoppable. Investors believed Japan represented the future of global growth. It was often said that the land under Tokyo's Imperial Palace was worth more than all the real estate in California, an illustration of just how extreme the valuations had become. But then things changed. After the bubble burst in 1989, Japan entered what's often called the lost decades. Stock prices collapsed, growth slowed, and investors who thought they owned the future were left waiting. It actually took until 2024, which is 34 years later, for the Nikkei 225 to finally surpass its prior peak. Imagine watching your market go sideways for more than 3 decades just to break even. That's why Japan remains a powerful cautionary tale. Even the most dominant-looking market can stumble, and it may take a very long time to recover. Today, the United States makes up roughly 2/3 of the global stock market. That's a huge share for one country, even bigger than where Japan once stood. Some investors look at that history and wonder, if it happened there, could it happen here? Including international stocks is one way people choose to reduce the risk of being over-concentrated in any single country. So how do investors put these ideas into practice? Different philosophies exist, and each has its champions. Some investors follow the lead of Jack Bogle and J.L. Collins, keep things simple, and keep it at 100% U.S. stocks, no international at all. They believe U.S. companies are strong enough, global enough, and efficient enough to carry the portfolio. Others prefer a blend. A common recommendation from Vanguard and many Bogleheads is about 80% U.S. stocks and 20% international. This splits the difference, acknowledging home bias while adding some global diversification. Still, others aim to mirror the actual global market weights, closer to 60-65% US and 35 to 40% international. This approach tries to reflect the real-world mix of investable companies worldwide. Each allocation has trade-offs. US only is the simplest, but has worked very well in recent decades, but it leaves you vulnerable if the U.S. enters a long slump. A blended allocation requires at least 2 funds, but it spreads your bets. And a true world market allocation is the most diversified, but it also could mean enduring long stretches when international lags, which can be psychologically tough. And that's an important point. Whichever approach you choose, the real challenge isn't just picking it, it's sticking with it when part of your portfolio is underperforming. Discipline matters as much as allocation. And that brings us to total world funds. These funds combine both US and non-US stocks into a single portfolio that mirrors the global market. The best known option is Vanguard's Total World Stock ETF, ticker VT, and its mutual fund version VTWAX. With just one ticker, you own the entire investable stock market, thousands of companies across the United States and international markets. The main advantage is simplicity. You never have to rebalance between US and international because the fund does it for you automatically. If global market weights shift, the fund adjusts. That makes it a very hands-off way to invest. But there are trade-offs. Control, for one, is a big consideration. In a world fund, the proportion of international stocks is set by global market weights, about 35 to 40% of which is international today. For many US investors, that feels high. As an alternative, holding separate funds gives you the flexibility to choose your own split. Maybe you're more comfortable with 10% international or 20% international. The point is, if you hold two separate funds rather than a total world fund, you get to decide. So ask yourself, do you prefer the ease of letting the fund decide, or would you rather set your own balance? And then there's taxes. Many total world funds, including VT, don't pass through the foreign tax credit in taxable accounts. I understand that the IRS requires more than 50% of a fund's assets to be foreign before that credit can be passed along. So VT mixes US and international, with the majority currently being in the US. It doesn't qualify. The takeaway is simple. If you want the foreign tax credit for investments in taxable accounts, you're more likely to get it by holding a separate international fund. And here are some other factors to consider when thinking about funds holding international stocks in general, whether as a total international stock index fund or a total world fund. Currency risk. Investing internationally also exposes you to foreign currencies. That means your returns can be influenced not just by company performance, but by how the dollar moves against the euro, the yen, or the yuan. In the short run, these swings can add volatility. Over long horizons, they haven't been major drivers of total returns, but they do add another layer of movement to your portfolio. Emerging markets. Total international funds include exposure to emerging markets such as China, India, and Brazil. These regions can have tremendous growth potential, but they also carry higher volatility and political risk. Russia is a recent example. For years, it was part of major emerging market indexes, but after its 2022 invasion of Ukraine, sanctions and market restrictions made Russian stocks essentially uninvestable. Index providers like MSCI and FTSE Russell removed Russia entirely. Investors who once held Russia as part of a broad emerging markets fund saw these holdings written down to nearly zero. That's the kind of political risk that comes with emerging markets. By holding them through a broad index, you're not betting on any single country, but you should be prepared for the unexpected. Correlation benefits. Another reason to hold international stocks is diversification. While correlation with US stocks have risen in recent years, they're still less than perfect. That means when US stocks are up, international stocks may sometimes be down, and vice versa. That imperfect correlation is what provides diversification value. And then there's the behavioral challenge. For at least the last 15 years, up until recently, US stocks have trounced international. Many investors have been tempted to abandon international altogether, but history shows long stretches when the reverse was true. Whichever allocation you choose, the real challenge isn't picking it, and as we've discussed, it's sticking with it when one side of your portfolio lags. It's also worth mentioning the classic Bogleheads Three-Fund Portfolio, built from a U.S. total stock market index fund, a total international stock index fund, and a total bond index fund. With just those three, you get coverage of nearly the entire investable world. It's become popular because it balances simplicity with diversification and shows how international exposure can fit neatly into a broader plan. And it is what a lot of target date retirement funds use as their basis. By the way, we'll explore target date retirement funds in a future episode. So where does all of this leave us? Total international stock index funds give you broad exposure outside the United States. Some investors like Jack Bogle and J.L. Collins say you don't need them at all. Others like Rick Ferri, Dahle, and Paul Merriman argue that they add important diversification, even if they don't necessarily boost returns. If you want to just add an international fund to your portfolio, you can look at Vanguard's mutual fund, VXUS, or its ETF version, VTIAX. Fidelity's equivalent is FTIHX, and Charles Schwab has SWISX. You can find links to each of these funds in the show notes. At the end of the day, it isn't about finding the perfect answer. In fact, there is no perfect answer because nobody knows the future. It's about deciding whether you value the simplicity of a US-only approach or the diversification that comes from spreading your bets globally and then sticking with it through thick and thin. And in the next episode, we'll keep exploring trade-offs, this time by looking at small cap value funds, a slice of the market that carries more risks but has historically offered higher rewards. We'll break down what the data shows, why some investors tilt towards small cap value, and whether it makes sense for you to do the same. If you found this episode helpful, please subscribe so you don't miss a future episode, and let others know about it too. Well, thanks for joining me for this episode of the LawyerFi Podcast. I'm Adam B. Cordover, and remember, financial independence isn't just a dream. Now let's go achieve it. This episode of the LawyerFi Podcast is sponsored by Family Diplomacy, a collaborative law firm. If you are facing divorce in Florida and looking for a private, humane alternative to a courtroom battle such as collaborative divorce, give us a call at 813-443-0615 or visit us at familydiplomacy.com. We accept clients in every county in Florida, and we have offices by appointment in Tampa, St. Petersburg, and Sarasota. You are not alone. We can help.
This has been the LawyerFi Podcast. Visit our website and learn more at lawyerfi.com, including information about how to become a sponsor. Watch or listen to us on YouTube, Apple Podcasts, Spotify, and anywhere you get your podcasts from. You can also reach us on Facebook, Instagram, TikTok, and LinkedIn. LawyerFi is hosted by Adam B. Cordover and produced by Eric Sachs. Original music is by Jake Biller. Adam B. Cordover is a Florida-based collaborative family law attorney. He is not a financial advisor, accountant, or tax attorney. This podcast does not provide legal, financial, or tax advice, and is for information and entertainment purposes only.